Welcome to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we perform a deep forensic breakdown of Amphenol Corporation, ticker symbol APH.
And this is such a massive topic for anyone watching the infrastructure space right now.
It really is. I mean, the core thesis we're laying out for you today is that Wall Street trading desks, mostly the generalist ones, are fundamentally mispricing this company.
Oh, completely. They treat it like a cyclical commodity play.
Right. They look at Amphenol and they see this volatile, basic component fabricator, like they just stamp out plastic connectors and copper wire for factories.
Yeah, which is just an incredibly outdated way to look at their business model.
Exactly. What they are missing is this massive structural transition. Amphenol isn't a commodity business anymore. They are this irreplaceable AI infrastructure utility.
A utility that holds absolute pricing power over the physical power grid of the future. Let's be real about that.
Yes, the physical power grid. Because, our mission in this deep dive is to tear down the financial and operational forensics of their Q1 2026 block.
And to show you why they act as this unavoidable physical toll road for the whole global tech boom.
Right. What's fascinating here is, wait, actually, I want to toss this to you. Because you look at the physical limitations of tech all the time.
Yeah, well, what's fascinating here is that everyone gives the glory to the chip makers, right? The software guys, the algorithm developers.
Oh, really? It's all about the GPUs.
Exactly. But the physical infrastructure dictates the true, actual limits of AI. You can have all the processing power in the world, but if you can't get power to the chip, it doesn't matter.
It's just an expensive piece of silicon sitting in a dark room.
Right. Physical engineering is the bottleneck. Always.
Okay, let's unpack this. We have to start with the mechanical variables of the Q1 block because the numbers are, they're staggering.
Staggering is the right word.
They reported record net sales of $7.62 billion.
Just massive scale.
Massive. That's an explosive 58% overall increase year over year. But even more wild, if you strip out the acquisitions, you're looking at a 33% organic increase.
Yeah, and we really need to pause on that 33% organic number.
Let's do it. Why is that so crazy?
Because, look, if you're a software company, scaling up 33% organically is, well, you spin up some more servers, you sell more digital licenses.
Right. It's virtually costless to scale software.
Exactly. But Amphenol makes physical things, engineered metals, polymers. To increase physical shipments by a third at a multi-billion-dollar scale is an operational anomaly.
It's mind-blowing when you really think about the logistics involved. But we need to talk about the earnings dissection here.
Yes. The GAAP versus non-GAAP gap.
Right, because there's a big gap there. Their GAAP diluted EPS was 72 cents. But their true underlying profitability, the adjusted diluted EPS, was a record $1.06.
Which completely crushed Wall Street's 95-cent consensus, by the way.
It destroyed it. But for someone looking at this, why is there such a huge difference between the 72 cents and the $1.06?
Well, the GAAP number was heavily weighed down by M&A integration costs and some tax provisions we'll get into later.
Right. The mergers are messy.
Very messy. They absorbed $249 million in acquisition-related costs in Q1.
Wow. In one quarter.
Yeah. And a massive chunk of that was non-cash amortization and what accountants call inventory step-up costs.
Okay, wait, let's break that down for everyone listening. What exactly is an inventory step-up cost? Like, explain it to me like I'm 5.
For sure. So imagine you buy a company. That company has a warehouse full of products that cost them $10 to make, but they sell them for $20.
Okay, simple enough. $10 profit.
Right. But when you buy the whole company, accounting rules force you to revalue that warehouse inventory at its fair market value right now.
Oh, so you have to mark it up on the books.
Exactly. You mark it up to, let's say, $18. So when you sell it for $20, your accounting profit only looks like $2.
Ah, I see. Even though nothing in the real world changed.
Exactly. It's a temporary artificial spike in your cost of goods sold. It drags down GAAP earnings, but it doesn't actually affect the cash the business generates.
That makes total sense. So when you strip out those accounting distortions, you see the true underlying P&L torque.
And that torque is just incredible. Look at their margin expansion.
Yeah, I wanted to bring this up. They hit an elite 27.3% adjusted operating margin.
Which is insane for a hardware component manufacturer.
It really is. Hardware margins are usually what, like single digits?
Oh yeah, 5, maybe 8% if you're running tight. But Amphenol's margin expanded by a massive 380 basis points year over year.
And that's Despite all the drag from the acquisitions, how do they do that?
Relentless operating leverage. When you have 33% organic growth, you're spreading all your fixed factory costs over a much larger revenue base.
So once the factory is paid for, every new dollar just falls straight to the bottom line.
Exactly. But, sales and earnings are just looking in the rearview mirror.
Right. They tell us what happened yesterday. To define the risk, we need to look at the order velocity.
The booking avalanche.
Yeah, because this is where the numbers start to look broken. They reported a record $9.435 billion in quarterly bookings.
Up a jaw-dropping 78% from Q1 of last year.
And up 12% sequentially from the prior quarter. This drives their book-to-bill ratio to an anomaly level. It's at 1.24 to 1.
So for every dollar they billed, they took in $1.24 in new binding orders.
I always like the dam analogy for this. Think of the book-to-bill ratio like a hydroelectric dam.
Oh, right, the water reservoir.
Yeah. The bill is the water flowing out of the turbines at the bottom, generating power today. The book is the water flowing into the reservoir from the mountains.
So a ratio of 1.24 means the reservoir is filling up 24% faster than the dam can release it.
Exactly. The backlog is just swelling. But I have to play devil's advocate here. Please do.
When you see a booking avalanche like this, you have to ask, is this just AI panic buying? Or is it a broader macroeconomic signal?
Well, that's the billion-dollar question. Because if it's panic buying, it evaporates next year.
Exactly. So what does the data actually show?
Well, the critical detail here is that demand has broadened comprehensively. It is not just an AI story.
Wait, really? The other sectors are growing too.
Oh, massively. Every single served end market recorded positive booking metrics.
Every single one. Even the legacy stuff.
Yes. Industrial sales grew 52%. Defense grew 44%.
Wow. 52% in industrial.
Right. So it's not a localized bubble. It's a global infrastructure reacceleration.
So you've got factory automation, heavy machinery, and the military complex all upgrading at the same time.
Simultaneously, Amphenol is just siphoning value from all these supercycles at once.
That is wild. But okay, let's pivot to the absolute powerhouse here. Because the broad growth is great, but the IT datacom segment is just exploding.
It's swallowing the whole company. It really is. IT datacom surged 99% in total dollars and 81% organically.
It's just an unbelievable figure.
And it now represents 41% of Amphenol's total corporate revenue, up from 36% last year.
The macro hardware upgrade cycle is just a runaway train right now.
Here's where it gets really interesting. We have to talk about the physical bottleneck here, the thermal realities of AI.
The heat problem.
Yes, because if you look at these next-generation 1-megawatt server clusters, like NVIDIA's Rubin platform, they run so incredibly hot.
They require a ridiculous amount of power.
Right, and if you use standard wire lines to deliver that much power, the wires will literally melt. They will catch fire.
If we connect this to the bigger picture, this is why the entire industry is being forced into a mandatory shift.
A shift to what exactly?
To 800-volt direct current, or DC power distribution architectures.
800 volts. That's like industrial factory power levels.
Exactly. You cannot use regular cables for this anymore. This forces a transition to specialized high-voltage busbars.
And a busbar isn't just a wire, right? It's like a solid block of metal.
Yeah, a heavily shielded, highly engineered block of conductive metal. And you need complex multi-branch wiring harnesses to route it all.
Plus liquid cooling, right? Because you still have to deal with the heat.
Oh, absolutely. Liquid-cooled bus systems are becoming mandatory. And who makes all of these custom-engineered mission-critical components?
Amphenol.
Exactly.
Let's talk about the total addressable market for this, because Citi Research put out some data that is just staggering.
The TAM expansion is almost hard to model.
Citi says the power delivery market is compounding at a 70% CAGR. 70%.
Exploding from roughly $2 billion in 2026 to over $12 billion by 2028.
A $10 billion expansion in 2 years.
So how does Amphenol leverage this bottleneck? I mean, they know the hyperscalers are desperate.
Oh, they know. And we have a concrete proof of how they are leveraging it. Wedbush just released a report confirming Amphenol instituted a selective 5% price hike.
A straight-up 5% hike on critical components.
Yeah.
Yep. Because they have absolute pricing power.
And the hyperscalers just have to pay it, right? Because there are acute component shortages.
You have no choice. The parts are custom engineered and critical.
Oh.
If you're building a $3 million server rack, you aren't going to cheap out on a power connector and risk burning down the whole data center.
Right. So Amphenol just effectively passes any raw material inflation directly to the customer. It proves their absolute pricing power.
It's an incredible moat. But, power delivery is only half the battle inside the data center.
Yeah, let's get into the other half, the transmission of data. Because there's this massive, fierce debate among hyperscalers right now.
The great engineering civil war.
Exactly. Do we build the next generation of data center fabrics using high-speed copper? Or do we use fiber optics?
It's a huge dilemma. Copper uses way less power, but it has severe distance limits. Fiber can go forever, but the optical transceivers use a ton of electricity.
Right. It reminds me of the early days of the railroads. You had different rail companies laying down different track gauges.
Yeah, standard gauge versus narrow gauge.
Exactly. And eventually they had to standardize because trains couldn't cross networks. So right now, these hyperscalers are laying down different gauges of AI infrastructure.
Some bet on copper, some bet on fiber.
And as an investor, you're thinking, which standard wins? If I buy a copper supplier and fiber wins, I'm wiped out.
But for Amphenol,
Yeah.
it doesn't matter who wins.
This is the masterstroke. Explain what they just did.
They executed this massive $10.59 billion acquisition of CommScope's CCS division.
Almost $11 billion. And they brought it under the Vistance banner, right?
Exactly, Vistance. And the financials of this deal are wild. It locked in $4.1 billion in full-year sales.
And 15 cents of earnings accretion, even with the near-term Jap drag we talked about earlier.
Right, but strategically, this creates an agnostic moat.
Because before this, Amphenol was mostly known for premium copper.
Exactly. But now, their pure fiber portfolio matches the size of legacy glass titans like Corning, ticker symbol GLW.
Wow. So they hold leading market shares in premium copper backplane routing, A&D active and passive optical modules.
Yep. So whether a hyperscaler chooses copper or fiber, they still have to pay the toll to Amphenol.
They win no matter what.
It's brilliant. Amphenol CEO R. Norwood had a great quote about this. He said, hyperscalers are demanding more interconnect no matter what.
Basically, just give us whatever works. We need all of it.
Exactly. And because of this panic, customers are completely abandoning just-in-time inventory.
Oh, that's a huge shift. Historically, hardware was always just in time to keep the balance sheet clean.
Not anymore. Norwood said they are opening the aperture of orders with massive upfront commitments.
So they are booking capacity years in advance.
Yes, which de-risks Amphenol's capital investments entirely.
So what does this all mean? I mean, we've talked about record revenue, $11 million deals. How are they managing the capital required to fund this supercycle?
It takes immense financial muscle,
Hmm.
but their cash generation is a fortress.
Let's hear the numbers.
They pulled in $1.1 billion in operating cash flow in Q1.
$1.1 billion in a single quarter.
Yeah, that's 120% of their GAAP net income. And free cash flow was $831 million.
So they are throwing off massive amounts of cash. But what about the debt from that CommScope deal?
That's the crazy part. Even with the M&A, their net leverage ratio is highly conservative. It's sitting at just 1.6 times EBITDA.
Wait, 1.6? That's really low for a company doing $11 billion buyouts.
Right. They have total debt of about $18.7 billion. But when you factor in their cash, the net debt is only $14.2 billion.
It's totally manageable with their cash flow, which I guess is why they can still aggressively return capital to shareholders.
Oh, yeah. They returned $485 million in Q1 alone.
Break that down for us.
Sure. $307 million went out as regular dividends, and then they bought back 1.3 million common shares on the open market.
At roughly $140 a share.
Exactly. Just a perfectly balanced capital allocation engine.
It sounds flawless, but, we have to stay objective.
Absolutely. This raises an important question. What could go wrong?
Right. We have to audit the long-tail risks, the forensic guardrails. We've got 3 core risks we need to monitor.
And risk 1 is a big one. The China geopolitical tax exposure.
Let's dive into that carefully. So Q1 showed a sudden $130 million tax accrual in China.
Yeah, and that triggered a prior period provision adjustment of $160 million.
Now, we need to be clear for you listening, we are completely impartial here. We do not take sides on left-wing or right-wing politics. We just look at the number.
Just the math on the balance sheet.
Exactly. And the math shows that Amphenol's long-lived corporate assets in China climbed to 37% of their total matrix in 2025.
37% of their physical assets in one foreign jurisdiction. That is a concentrated operational footprint.
It really is. I mean, they did it because the PCB fabricators and final assembly lines are in Asia. You have to build near your customers.
Right. Logistically, it makes sense.
Right.
But geopolitically, it poses a severe tariff and trade headwind.
Hence the $160 million tax provision penalty. It's a real quantifiable risk.
Absolutely. Then you have risk two, which is downstream affordability,
Brett, we just talked about their 5% price hike.
which is great for Amphenol's margins today. But if they keep hiking prices, eventually the downstream hardware producers are going to hit an aggregate demand affordability wall.
Like, the guys actually building the physical server racks won't be able to afford the parts.
Or they won't be able to pass those costs onto the final enterprise buyers.
And if those downstream margins compress too much, the whole physical build-out slows down.
Exactly. It would cascade right back up the supply chain to Amphenol.
Okay, that makes sense. Let's move to risk 3, defense performance clawbacks.
This is a fascinating one because defense is growing at 44% for them right now.
Mostly through their harsh environment division, right?
Yeah. They make these heavily shielded connectors for missile defense, munitions, aerospace avionics.
Stuff that absolutely cannot fail.
Right. And because of that, there's a strict federal executive directive right now. It's called Prioritizing the Warfighter in Defense Contracting.
Okay, what does that actually mean for the stock?
It means if a contractor underperforms,
Mm-hmm.
like if a component fails or delays a massive defense rollout, there are strict bans on routing capital back to equity holders.
Wait, so if the harsh environment division messes up, the government can literally freeze their stock buyback engine?
Yes, they can legally block that capital return allocation.
Wow. So flawless execution isn't just a goal, it's a legal necessity to protect the buybacks.
Precisely. It's a massive forensic guardrail to keep an eye on.
Okay, so we've weighed the risks. China concentration, affordability walls, defense clawbacks. Let's bring all these threads together for the final verdict.
Yeah, because we have to look at the Q2 2026 guidance they just dropped.
And it is a monster forecast. They mapped top-line revenue up to $8.1 to $8.2 billion.
That's a 43 to 45% explosion year over year.
And earnings are projected at $1.14 to $1.16.
But the most important part of that guidance is what they said about IT Datacom.
Right, the segment that just grew 99%.
Management explicitly guided for a further low-teens sequential increase in IT Datacom.
So it's still accelerating, it's not plateauing.
Exactly. The build-out is gaining speed.
So how are the institutions digesting this? What's the mandate for allocators?
The institutional view is definitively bullish. Evercore put a $180 price target on it, calling it a core asset.
And Citi is super bullish on the 800-volt DC transition.
Right. The definitive accumulation mandate is clear here. You can no longer view Amphenol as a cyclical manufacturer.
They are an indispensable physical infrastructure toll road. Well, I want to leave everyone listening with a final provocative thought. We've established Amphenol is the gatekeeper to the AI revolution today.
They own the plumbing.
Right. But what happens in the 2030s? When our ambitions for artificial intelligence run into the absolute finite physical limits of the global electrical grid.
That is the real bottleneck.
Exactly. Does the toll road operator eventually become the primary architect of global energy usage? If you control the absolute most efficient way to transmit power, you effectively control the grid.
A wild thought. The sheer physics of their hardware might dictate the future of global energy.
Risk defined, portfolio protected.